Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by.
Investing. Thanks for joining me on this one. So I've talked in the past about being a CFA Level 2 candidates, and I was going to talk a little bit about that program, how it works. I want to not really talk through the CFA website and talk about all the different sections that they have. Instead, I want to look at an example, bond pricing. It's going to give you a sense of how deep you're going to go into finance, and I think, for me anyways, one of the things I really appreciate about the CFA program is that you get really deep into the weeds where you have a mathematical understanding of what's happening at a very fundamental level. I think that sometimes working in finance, real estate, accounting, people don't have that understanding. And it makes sense to me that if you're gonna go really far in this field, you want to learn this all the way down to the nuts and bolts, and you'll always have it forever. So sometimes, we're here on Bloomberg, and I just was looking at the Treasury yield. But someone asked me, is this bond price that was quoted from my Edward Jones advisor? They were telling me, is this a buy? Is this a good price? And it's really interesting because I was actually stumped a little bit on a couple of issues, and it actually reinvigorated this idea of going back and learning, getting all the way down to the nuts and bolts. So you'll see something like this, Treasury yields, right? These are some key rates. Sometimes they will give you the price and the yield. They won't always give you the coupon, but Bloomberg does. And so if we look here at the bottom of the 30-year, they say, okay, it's a 4.75 coupon, selling for $99.81, and this yield, 4.76. And I think it's highly possible that, what is the 4.76 yield? Is that the discount rate we're using when we're going to price the bond? Is that the 30-year spot rate? Is this a 30-year par rate? What is this? Where is this number coming from? What do I do with it? What does it even mean? Okay, so carrying over from the 30-year bond example that we just took from Bloomberg, you're going to use basically the same components that you use on the BA2 Plus or whatever calculator you're using for the CFA Level 2 exams, but you basically have a future value, so in this case 100, some discount rate, years to maturity, in this case since these are treasuries, these are semi-annual, and you need the coupon, and with those things you can calculate the present value, right? Those are your keys. The calculator, it actually says the IY, right? And so again, what does that mean? What does IY mean exactly? So if we put in the 100 for the future value, the 4.76 on that key, we're doing the 4.76 divided by 2 because it's a semi-annual. We have 30 years to maturity, but because we're having 2 payments or 2 coupons per year, that doubles the number of periods from the 30 years to 60 periods. And then the coupon rates, it was 4.75. We got to divide that by 2. And the formula for this in Excel is a little different to get the present value. It's the PV, and then you're taking your, it'll tell you how to do it. It looks like the blue, then the red, then the purple, and the green. And it'll give you the present value. So 99.84. It's pretty close to the price that they have listed here, 99.81. Really, really, really close. Maybe some difference in liquidity. We can do the same thing for the 10-year. It's got a 4.65% yield, is what it's telling us, right? A yield of 4.65 and a coupon of 4.50. So we'll go do that. And if we do that, it's 100. It's the 4.65 divided by 2 on the IY. 10 periods, but 10 years, but 20 periods. And then the payment would be the coupon, 4.5 divided by 2. You get 98.81. 98.80. So it's the same. What does that mean? What are these yields then? When you go out in the marketplace, you look on a website or whatever, what does this yield? Well, what this really is, it's the yield to maturity. Okay, so what does that mean? Like yield to maturity, because that's another term that people throw around. You might think in a very, very basic way. That's the return I'll get if I hold this until maturity. Yeah, which is true, but like, what does that mean mathematically? I mean, how does that look as far as discounted cash flows? So let's look at that, because that's like the next really interesting thing. So what we're going to find out is that the IY button on those calculators on the BA2 Plus, anyway, from who makes that, Texas Instrument, is going to be the same as yield to maturity. And then we're going to go and look at what yield maturity is, because again, like, this may not always be clear. I don't think it's clear to most people, and that's what's so great about the program. So if you're living in Excel, it's going to be the equal sign rate formula, and this is going to be the equivalent to the solving for IY on those calculators. So it asks for number of periods, so we all have 60, comma. We have the payment is $238 per period. The present value, this is essentially what was given to us in the Bloomberg website. Future value, there. It's hard to see, but it's there. And then, what's the last thing it wants? Will be paid at the end of periods, not at the beginning of periods on treasury bonds. And hopefully I don't have to make a guess, but I think it's 0.0499 or something. And let's see what it gives us. It will give us 2.380. So you can, you're always solving for the fifth variable. So if you know the price, you can calculate the yield to maturity using the rate formula. Okay, so anyway, that's just an example of what's going on in Excel. If you want the yield to maturity, it's the rate. Now, I haven't really proven that this IY button is actually the yield to maturity, or what the yield to maturity is. Okay, so we're going to scroll up here and actually look at, like, what is the yield to maturity? Like, what does that mean conceptually, mathematically? What does it mean beyond just, if I hold this bond until maturity, then I'll get this percentage return? We're only going to be able to do a simple example, but you can double check it easily on your calculator if you like, or we'll do the same thing with the rate formula that we just did below, that we just proved it was the same, the 2.380 using rate, because we'll use rate here as well, same thing. So we're going to do that, but we're going to break it down like this. You have 3 years, 1, 2, 3 years, and these are your cash flows. You get 5, 5, and 105. So you know that the coupons are 5 years, it's a 3-year. In this sense, we're just going to do annual pay. So spot rates. Now, you may think, what the heck is a spot rate, right? What is a spot rate? We're going to look at that here in a second, because, again, super helpful. I mean, if you go into these tests or, work your way around fixed income, it's amazing once you get it. So spot rates, I put them in red here. So 6% in the first year, 7% in the second year, and 8% in the third year. So these are going to be your, and then I raise them to their appropriate exponent. So raised to the first for the first year, but here 7%, so it's compounded 2 in the second year, raised to the third power in the third year. So what that's going to equal mathematically is 1.06. The first year is going to be your discount rate, right? This means you're going to discount the $5 one period back at 6%. Here, you're basically going to take the 5 and divide it by this number, right? This is the numerator, the cash flows, the denominator is the discounts, right? And this is going to be your rate of discounts, 1.07 squared, right? So you'll essentially be divided by 1.449. And then the same thing, 8 raised to the third, here you can see the third year, we'll give you this number. So now what we're doing is dividing the 5 by the 106, the 5 by the 1.1449, and the same thing, the 105 by this number. So these are you gotta have spot rates. Spot rates, you're able to raise them to the appropriate power of the year. You're not able to do that with par rates, and you don't do that with forward rates either. So you gotta know what the difference is, and after this, we'll go from par rates to spot rates, so we can understand how those are calculated, how we arrive at those. And but anyways, now you're going to get the discounted cash flow, right? This is, we just saw this, but 5 divided by the 1.06 gives you $4.71,698,113 present value from the first year. You're going to get $436,719 from the second year. And the third year, if you present value that $105, will be $83,352 and some change. If you add those up, they sum to $92,436. $92,436. I'm just adding this, and this. Right? Now you're back to calculator work. You're at this is the sum of the discounted cash flows. So this is your present value of all your cash flows. So you found the present value and you add them up. So it's the sum of the discounted cash flows, also known as your PV, right? That's what you'll find on your calculator. PV, future value is 100. We know future value is 100. 3 periods, we know the coupon is 5. And if you put in that rate formula, 7.93. So what is this? What does this 7.93 even mean? Okay, so I just added this part. So if I double talk, sorry, but what is the IY? What is the yield to maturity? What is that? The rate in Excel, the IY on the calculator, the yield to maturity that your broker quotes you. What the heck does that? What does that mean mathematically? So what that means is that if we stick a 1 on the beginning of it and turn it into a discount factor or a discount rate, right? 1.07931. I just went to 93. Oh yeah, that's right. Oh no, it's not right. It's 1.079. 1, 2, 3. Like this. Okay. What that means is that would be well, you could just see it. It's better to just see it in the math than try to describe it verbally. You still have your same cash flows: 5 in the first year, 5 in the second year, 5 in the third year, right? 105 in the third for your final payments. And what is this? If you take the discount factor, the yield to maturity that we found, you raise it to the first power, that'd be your first year discount rates. If you square that in the second year and you raise that same number, this one, 1.079,123, to the third, in the third year, that would be your compounded discount rate for each year. Then you discount each cash flow by its respective, say discount rate for that period. When you sum these, you're going to get 463, which is not the same as when we did it this way, with these spot rates changing different years. This was 4.71 discounted rate. Here we get 4.63. $4.29 and $83.56 in that third year. To change it to a number, it's going to be the same, $92.48. Why is this not right? Just because I left out a 3. 7, 9, 3. 1, 2, 3. 92.44, 92.43, 65. 366. 36. So you can see that's what the yield to maturity is. It would be as if it's like a rate that you could apply to all of the years. It's not the spot rates. It's not the same. The 6% spot rate in year 1, the 7% spot rate in year 2 that you can compound, the 8% spot rate that you can again, compound, raised to the third power in year 3. Spot rates are great for that, but that's not what yield to maturity is. Yield to maturity is what's the you could say the discount rate at every for all the years, for all the payment periods. That's what yield to maturity is. It's a single number that if I discount all of my periods at, I'll come up with the proper present value. And that's important because that's what Bloomberg is giving us. And that's what many of the things that you'll find either quoted by your broker or, that you'll find on websites, yield to maturity. That's what we're calculating when we calculate the yield to maturity. And that's what it is. It's like a universal discount factor that you could use on all that you want to use on all the periods. And so it's a different number. They also bring up something really interesting that if you think about, they describe it as a yield to maturity as a money weighted discount rate, I think would be the right term. Meaning money weighted, what do you mean? Well, you have 5, 5, and 105. So you have $115 of cash flows coming in over the period, right, over the full life of this example. Well, the 5 divided by $115 represents about 4% of the total cash flows that you're going to receive. You receive in the first year. In the second year, you receive another about 4% of the total that you're expecting to get. And in that third year, 91% of all your cash flows are going to come in. What that means is they say, look, realize that, I guess just compare. You have an 8% discount rate here in the final year versus a 7 and a 6 in the 2 previous years. And what's your yield to maturity? Almost 8, 7.93, right? So these bigger cash flows mostly kind of pull the average, I guess you could say. That's why they say it's a money-weighted average. So it's very close to that final year. Whatever your discount rate is in the final year is going to matter a lot. That's really interesting, actually, if you start to think about it, because typically in these problems or in these examples, when we go through programs or go through university or whatever, we're just given, right? Here's the given information. Can you calculate and arrive at the right answer? But in real life, these spot rates aren't subject to change. I mean, and so that brings me to like the next point of like what the heck are spot rates, right? Because this was something I was thinking about. Like, yeah, I mean, fine, these are given in problems. Here's your little table. Here's your spot rates. Go find us our answer. But when you go into like real world questions, real world problems, like you need to understand. I feel like I need to understand what this is at a fundamental level. So let's go look at some par rates then. Okay, so I'm going to jump into par rates next, but I just want to return back to our question. My mom calls Edward Jones, like I said. It's quoted a 4.5% semi-annual 30-year U.S. Treasury bond with a 15-year tenor. Quoted price was $99.16 with a stated yield to maturity of 4.57. Is this a reasonable price to pay? We at least know now what the yield to maturity means, like mathematically. We have a good grasp on that. But let's keep digging, because I think it's really interesting to see the other steps that come into is this a reasonable price, and understanding how the par rates affect the spot rates and why you can check it, but you need to understand how reliable that check is going to be. So ultimately what we're going to do is we're going to go and get some spot rates. But what the heck are spot rates? Spot rates are derived from par rates. So let's go look at those real quick. Okay, so par rates, again, I think are super interesting because these are often given to you. Spot rates, par rates, these are just like given in this information as you're going through problem sets or lecture series. Okay, par rate. This is the best I've been able to figure out for what a par rate is. A par rate is a bond that is trading at par, meaning that if you have a bond that has a face value of 100, you look into the market, right? This is the definition we're always given, and it's trading at par, meaning the current price, the PV on it, is 100. Okay, what does that mean? Because what rate are you using in order to calculate the Like, what's the discount rate on a par bond, basically? And there's only so many variables that you need to know, right? You need to know the PV, which by definition, par is trading at par, it's trading for 100, so you know PV. You know the future value, that's 100, also like given intuitively. In this example, it's a 1-year bond, and I'm just going to say that it's a 1-year annual pay, so N is 1. The coupon, I just made this number up, but let's just say that it's going to be stated on the bond. I mean, everybody's going to know, just like when we looked at that Bloomberg site, the coupon is going to be given, or it's obviously going to be stated on any bond. And so the last remaining factor is like, well, what's the discount rate you're using on that? Well, mathematically, it obviously has to be the same rate as the coupon. So what does that mean? Like, what is a par bond? All that really means is that you're just going down a list. I mean, as far as I can figure, you're just looking in the market for bonds that happen to be trading at par at 100, right? So that's the current price. And since the coupons are stated and everyone knows what those are, all that means is that on the particular day that you happen to be looking, that the current, say like 1-year discount rate, or the current YTM, the yield stated, is just whatever by chance happens to be, in this case, so 2.2%, right? Maybe tomorrow things change and it's 2.1%. So the bond that we were looking at on Tuesday is no longer a par bond on Wednesday, which is really interesting to me, because I always got this sense that like these things just exist on their own, like they are just kind of cornerstones of finance and you can just find them. But I mean, when you go to think about it, all it really is that there's some. It just means that this is the current yield on the 1 year. I mean, it just happens to be 2.2% at this time, right? I mean, that's all that really is. Like I said, tomorrow, the new par rate could be 2.3%, 2.4%, or 2%. It could go up, it could go down. So one of the fundamental questions I found myself asking is like, what in the world is the discount rate being applied to a par bond? Where is that coming from? And all I can think is that has to be the yield to maturity, whatever is offered on the 1 year. So that's a little bit circular in my mind. I find that is sort of odd that the discount rate on the par bond dictates the 1 year spot, which then mathematically just moves forward. So let's look at par rates and try to get a little bit better grasp of what those are. Here's an example from the book on how to calculate spot rates from par rates. So again, like I said, in this example, par rates were just given. It was just set at 5.97%, 6.91% in year 3, and 7.81% in year 2. These are given to you because they end up being really nice round numbers when you calculate it. I will also say, you should notice that this is an upward sloping curve, right? 5, then it goes up to 5.9, and 6.9, and then 7.8. So it's an upward sloping curve. One of the things you'll notice is when you have an upward sloping curve, the two rates are the same in the beginning. So the par is the pink and the green is the spot rate in this situation. And they make a big point that the spot rate will lie when you have upward sloping curve. The spot rate and the par rate will start at the same place, but over time, as you 2, year 3, year 4, year 5, as you find the calculations on the spot rate, it's going to lie above par, and we'll see lie above the par rate, and we'll see that happening as well. Okay, so like we just saw on that chart, basically the 1 year spot and the 1 year par are going to be the same. But the way that works is it's actually not mathematically that difficult, but it's a little bit, there's some steps to it. So the way it works out is you start with your final year cash flow seen in the numerator. So you're going to make in this sense, I just broke it down as if it's just, instead of like $105, it's just $1.05. You can move the decimals around, but it saves you some legwork just to think of it like this. So at the final year, I'm going to get $1.05. Intermediate cash flows, meaning any cash flows that came in before the final year. There's no intermediate cash flows. There's just the final payment on a 1-year bond. So nothing to do, nothing to see here, nothing to see here. You're going to take 1 minus the discounted intermediate cash flows. Well, since there are nothing in the blue, we still just end up with 1. And then it's the final year divided by the pink, 105. Final year brown divided by the pink gives you 105. And your new spot rate, basically drop the 1 off and you have a 5% spot rate. So the par rate and the spot rate are basically the same. You can see a little bit, it makes more sense in the second year. So let's go through the year 2. You start with the par rate in year 2. So this is going to be the amount of money you're going to get in every period, right? So in my first period, I'm calling this the intermediate cash flows, I'm getting basically a little bit more than 5 cents, and I need to discount that by a discount factor. And I'm also going to get the same 5.97 cents at the end. So I'll get $1.597 at the end, and I'll get a 5.97 in the middle. But I need to subtract, or I need to discount that first year cash flow. Maybe this is a better example. I get the 5.97 here. I know I'm going to be dividing it by the first year spot rate. Well, that's really cool. Raise to the first. But then I need to plus some, I'm trying to find this second year spot rate here. You can see. I'm trying to find what is this rate here that I need. I know this, I know this, I know this. I know it's going to equal 1. What is this going to be? And so obviously how would you do this, right? How would you solve this problem? You'd figure out whatever this number is, this divided by this, which ends up being this number, the blue here, the 0.0597 divided by the year 1 spot rate. So obviously, like, I want to subtract this from both sides. This will go away. This will become some number less than 1, right? So that's what we're doing here. We're discounting this. We're finding the discount of the intermediate cash flows in year 2. We're dividing it by the, we're discounting it, and then we're subtracting it from 1. So that's why we get to 0.943, so some number less than 1. And then what do I have to do? What would you do after you have, 0.94 over on this side, right? Well, you could multiply both sides and bring this over here to get your exponent on the right side. And then you divide the 1.0597 divided by the 0.94, which is what we're doing here. We're taking the big number, the 1.597 here, divided by this pink number. So the blue divided by the pink, and you'll get 1.12357. So that's going to end up becoming your spot rate, right? But it's like squared. It's a squared value. So you're going to need to take it, basically, you're going to need to take the square root of that. Since it's a squared number, you're going to need to take the square root and subtract off your 1, and you'll get almost a 6% spot rate for that year. So spot rates are given to you as like a number that you need to raise to the appropriate exponent, right? Given whatever year you're in. So it was 5% discount rate on the first year, but it becomes almost 6% in the second year. Right. So that's what you're doing. It becomes a little more complicated. You can see the more and more you go to do like a third year, you're going to get your par rate is going to be your numerator in every period. So you're going to get, for sure, you're going to get the 1.0691 in the final year, and you're going to get 2 of those in the middle. So you're going to get you're going to get whatever the par is times the number of, you're going to get 2 years of that, so times 2. So that'll be like 13, almost 14 cents. Then you need to discount that by some number, right? Because you got to get the present value. Now this is where it's tricky, because the first cash flow, so the cash flow that came in year 1, you're going to divide it by the spot rate for that year. And then the cash flow in the second year is going to be divided by the spot rate raised to the second power, right? Which is this compounded spot rate. It's not the 1.059992. It's squared. And you can see that here. What is this number? It's the 1.059992 raised to the power of the appropriate period, so squared. So that's kind of a lot of work to get to this number, right? Because you're referencing the par rates, which is again really interesting. What are the par rates? These are basically discount rates that are applied to bonds that just happen to be priced at $100 on the day that you look at it. So this is a little bit not as straightforward as it is in like test questions or exams, or when you're just kind of handed these numbers. I think once you start to dig into it, right, a little bit, you're like, these are not static numbers or stationary or fixed numbers. Like, they are for the simplicity of exams, but in real life, these are going to be changing constantly. And so this whole like curve, this waterfall of going from par rates that are going to end up in your numerators, and then that are also going to factor into your spot rates, which are going to discount. They're going to be your discount factors in prior years, or from prior years, you could say. Like here, the spot rate that you're using in year 2 was really dependent upon what the par rates were in the very, very beginning. Year 1, year 2, year 3, year 4 par rates, as you'll see, because it's all compounded, all linked together, and it grows. So then, you know that by the time you do all the work, you're going to take the final year cash flow, which was this brown one. This brown one, divided by the pink, and you're going to get this. That's going to be a number that, oops. You're basically taking the blue and raising it to the 1/3. So you're taking the cubed root, and then you're subtracting off your 1. So that gives you the 7% spot rate for year 3, right? You can see when you go to year 4, you found par rates. What's a par rate for year 4? It's a 4-year bond, right? Where the coupon is set, and somebody goes and looks to see which one of these bad boys is selling for $100, right? Or $1 or $1,000, whatever, that is equal to the face, and then they're taking that rate and dropping it into a par, like basically a table of par curves. So in this case, it happens to be 7.81% is you could say discount, but it's also the cash flows that we're going to use for our next calculation for our next spot rate, right? So let's just start from the beginning. What's the final year cash flow for the 4th year? It's going to be 1 plus 0.781, so it's going to be $1, and then these pennies, or portions of a penny. So we know we're going to get that at the end. But what about the intermediate ones? Well, we're going to get this, and we're going to get 3 times, right? We're going to get 3 of those. And you total them up, and it ends up being about 23 cents, a little bit more than 23 cents. And we need to discount those. How are you going to discount them? You can't discount them by a single number. I mean, if we had a yield to maturity, then we could discount everything by a single number, and that'd be real slick and easy. But we don't have that. I don't see it in my mind. Certainly don't find it on this chart. So you gotta do it the hard way. What's the hard way? It's going to be, you're taking this cash flow, and you're going to have to divide it by, you have one of these, and for the appropriate period, you're going to have to divide it by this number. You're going to have another one, so plus another one of these divided by, it's the 1.059992 squared. So that's going to be it discounted in the second period. And in the third period, you're going to have one more of these intermediate payments, but you got to divide it by the third year compounded spot rate is what I'm calling it, divided by 1.22506. And what is that? It's this number raised to the third. Right? You can see that. What is this? It's this raised to the corresponding period. So 3 periods. You add all those individual cash flows discounted by their respective spot rates. Then what you're doing, you're taking 1 minus the intermediate cash flows, just like we did here. This was our intermediate cash flow, so we take 1, we subtract it on this goes away, this becomes a number less than 1. In this case, it's 7.7923 and some change. And then what are we doing? We're going to have to take the final year cash flow divided by this pink number, 1.3606. Then what do you need to do in order to convert that into a new spot rate? You're going to take the number that we arrived at, the blue one, and you're going to raise it to, you're going to basically root it. So raise it to 1 divided by 4. So you're going to take it to the 4th root, basically. And then you need to subtract off your 1, of course, and it'll give you basically, this in decimal form, but it's 8% basically spot rate. And so if we weren't taking it out to all these long numbers, you could see it'd be really clean. It's a really clean example to say, if you have these par rates, 5, 5.97, 6.91, 7.81, you're going to get these really clean spot rates. 5, 6, 7, 8, right? It's going to be like a freaking bad workout routine or something. 5, 6, 7, 8. Right, so they chose it like that to make it like really clear, so that it's nice and neat and presentable in the end, and it goes to the, it goes to the at least 2 decimal places back if you were to convert it to percentages. So it looks really pretty in that sense, and you can see all the math, but you can also see like how much work it takes to get from par rates to spot rates, and you can also see that if these par rates change. If I do all these calculations on Tuesday and the par rates change on Wednesday, which they must, they have to, it means that all these spot rates are going to also shift. Okay, so that I think is like super interesting when you go back to this question here of you call your broker and they quote your price of $99.16 with a stated yield to maturity of 4.57% is a reasonable price. Clearly, what you're not going to do is go and start calculating, find a par curve and start calculating spot rates. And in fact, if you try to do that, you'll realize that par rates are typically only given at key rates. 1 month, 2 month, 3 month, 4 month, 6 month. Okay, that's fine. I don't need any of those. But I need the 1 year, I need the 2 year, I need the 3 year. And then it skips to 5, 7, 10, 20, and 30. This whole thing breaks down. If you start to try to use that, it'll break down as soon as you have a gap, right? Because I need all the par rates at every level. So I need this 4th year par rate for my numerators. If you don't have that, it's all going to fall apart. You're not going to be able to continue on like bootstrapping, so to speak, your spot rates from given par rates. So what are you going to do? What you have to do is you're going to have to go and find given spot rates, and you can find those. In fact, you can find them. I found them from NASDAQ.com. It's the U.S. Treasury zero coupons, because spot rates are supposed to be the same as zeros, as the yields on zero coupon bonds. So you can find those. And in fact, I found those back in October. Where that finally leads us after all that is a few things. You can you can quite easily like go and check their work in some sense and say, did he quote me a fair price? And you could put in the again, sorry, what is this? It's really a 15-year bond at this point. I mean, it's got a 15-year tenor. They'll quote you the price, and so you're going to use the 15 years. And can you mathematically check that the yield to maturity is correct on what they gave you? So they're going to give you they're going to tell you, like you said, the 4.57% yield to maturity. So you're going to put that in the IY section. You're going to divide it by 2 since it's a semi. So I'm going to have basically 30 semi-annual payments. This is my yield to maturity divided by 2. I'm going to get $4.50 a year, but I'm only going to get $2.25 every 6 months. Future value is 100, and you can put in your rate calculation, and it'll come to what they quoted you. But that doesn't give you anything. Like, that doesn't tell you. That just means like they didn't screw up the math. You can also do it a little more simply. 15 years, 4.57%, $450 payment per period if this was an annual pay. And you can see that the yield to maturity is almost identical, meaning that those extra compounding periods don't help you that much. It's correct until the fourth decimal place, right? But almost identical if you don't want to go through the hassle of compounding it, twice a year. You can just almost put in the annual numbers and come to the same yield to maturity. So you can check that, like, yeah, yield to maturity checks out. If you back check it, you could also stick this number here, fund the payment, and the payment would come out to be $99.16. And so, well, that's what they quoted. But I mean, that doesn't really, just because you took out your BA2 plus and calculated, you got the same number. Like, that doesn't mean anything. What you really need to do is go find the spot rates, the current spot rates. You know your coupons. It's $4.50 every year. And the important part of this is because I did actually call a tutor because I wanted someone to double check like my work on what we were doing here. Because I came up with a price of $94.93, and you'll see how I arrived at that. But $94.93 and $99.16 is a huge difference in terms of price. So how did I come up with these are the discounts. And this is, I'm taking 1 plus, so I'm starting with the blue, plus B50 divided by 100. What's B50? B50 is the rate. They gave it as whole numbers, right? This is a 5%, 5.3407%, 1 year spot. So you got to divide that by 100 to turn it into decimal. And then you're raising it to the power of the whatever corresponding period you have. So that's the 1. Here it's going to just be 1 plus, what's this number? 5.0375 divided by 100 squared, raised to the second period. So you got to find all your discount rates. It's going to be the same. This is going to be 1 plus whatever's down here, given by NASDAQ. The spot rate's basically given by NASDAQ for the 3 year. And really, you realize that they calculated that. Like, they calculated that based on wherever they went out and they found those par rates, they calculated that. And you basically have to take these numbers as gospel because, like I said, there's no way that you're going to be able to calculate that on your own. 1, if you didn't have anything to do all day, you could go through this process. But 2, a lot of times the par rates are not even given in all the periods that you need. So you almost have to go and find these numbers calculated by someone else, and they're going to have to extrapolate or whatever. I'm not sure, but as far as I can tell, they're going to have to like estimate the 6 year in this case, the rate for years 8 and 9 in this case, years for all the years between 10 and 20, and all the years between 20 and 30. So these are, again, calculated numbers. It's not like so straightforward as it appears to us. Anyways, if you discount all these cash flows, meaning you take the 450 at each period divided by its cash flow, just the 450 divided by whatever the discount rate is, the appropriate compounded spot rate for that year. You're going to get a bunch of cash flows. You add up all the cash flows here, and you're going to get to 94.93. 94.93 is significantly different than 99.16. So obviously what you can see is the difference is quite significant. I mean, this is, we're doing this per 100. So it's 94.93 minus the quoted price 99.16. It's $4 difference. And if you're just taking that $4, and in this case we're using groups of 100 or based on $100 notional or $100 face. But if you're doing something like 400 contracts, it ends up being $1,600 difference. So this is $4 difference between quoted and calculated based on $100, and if you're going to do like $40,000 investment, it's like $1,700. So it's like this. Why is this so off? And we basically ended up deciding that it's either from liquidity, because these 30-year-old treasury bonds. I mean, that was the answer the tutor gave me, was that, you know, the math checks out, going in the market, finding the current spot rates, discounting the coupons, arriving at a current price, comparing the current price, 94 to 99, you see it's severely mispriced. And so it's like, just because they tell you that, oh, the yield to maturity is such and such, and you can punch all those numbers into your calculator and say, yeah, it looks right. If you go one level deeper and know what to look for, you can really see like, yeah, I don't want to overpay $1,700 for this, right? This is a really atrocious price, and ultimately something we decided to, you know, walk away from and go and look for something else. So this is, I think, the real value of CFA, is that you can start to connect the dots. You can see how tedious it is, I suppose you could say, of calculating spot rates, but you can also see this is where spot rates come from. And you can also see a little bit of the logic behind the whole thing and say, well, these are calculated numbers, and they must be calculated from somewhere. It's not just like, just because you read this off a website, here's some par rates. It doesn't really mean that much, because you have to think, what is a par rate? How does a par rate become a spot rate? And then how do we take our spot rates and turn them into forward rates? Spot rates, par rates, yield to maturity, they're obviously not the same thing, right? And so being able to have like a really good grasp when people come and start throwing around these terms, whether it's a financial advisor or some friend or hopefully a future client, you'll be able to say, I understand way more than just yield to maturity is how much money I get if I hold this thing until it matures, right? I mean, anybody can like kind of like walk around and feel like that's what that means, and they have like a somewhat functional definition for it. But being able to really understand at a root level, this is what's coming into this is what we're putting in our calculators, this is what the IOI button means. It's sort of related to spot rates, but it's like kind of like one universal spot rate is how I'm thinking of it. The 7.93123%. How that relates to spot rates, where spot rates even come from, how they're derived from par rates. And so you can see like kind of the whole process from beginning to end, and then really make sense of, like I said, when things aren't quoted to us. Like we actually get it. We are professionals. We understand the nuts and bolts down to the basics. I suppose it's not that different than like the difference between like the regular Joe or Jane and your local car mechanic, right? You're like, oh yeah, like 916 wrench or the old 10 millimeter. But like, you don't even know the names of like half the suspension parts on your car, I'm guessing. I mean, I don't. How the internal workings of an internal combustion engine, sensors, all that stuff, right? I mean, we don't really know those things unless that's your hobby. So, anyways, I think this is kind of what CFA Level 2 is about. It's about getting down to really like the fundamental aspects of finance, which is, primarily time value of money, which is primarily discount rates, which are not just given to you in real life. Like, they are available, but they're also not rock solid numbers. They don't, it's not like they're just decided upon. They are calculated numbers, and so we see how it all works. Anyway, thanks for watching. We'll talk to you next time. Bye.